So you're buying your first HDB flat. That is a huge milestone. But beyond all the excitement of getting your keys, there's a really crucial decision that's going to shape your financial future for years, maybe even decades. So today, we're going to break down how to finance it smartly.
You know that feeling, right? You're picking out a unit, dreaming about renovations. It's all part of the fun. But before you even think about paint swatches, there's this foundational choice you have to make. How are you actually going to pay for it? This is a choice that's going to have financial ripples for decades.
Okay, so you're basically at a fork in the road with two main paths for your home loan. On one hand, you've got the loan from HDB itself, the Housing and Development Board, and on the other, you have a loan from a commercial bank. Now, they might sound kind of similar, but trust me, they lead to very, very different financial journeys.
Let's start with the number that every new homebuyer is thinking about, the down payment. Basically, this is the chunk of money you've got to put down up front, either from your savings or your CPF. And this is where you'll see the first major split between these two loan types. And right away, you see a huge difference. A bank loan needs a 25% down payment, and, this is key, at least 5% of that has to be in cash. The HDB loan, though, is way more flexible. Not only can the down payment be smaller, but you can pay the whole thing using your CPF. That means you get to keep your cash for renovations or just for a rainy day. And that right there is a massive advantage.
So this slide really gets to the heart of the trade-off, doesn't it? It's stability versus potential savings. The HDB loan gives you this incredible predictability with an interest rate that's been a rock-solid 2.6% for years. Bank loans, on the other hand, they're tempting because their rates often start lower. But here's the catch. Those low rates are usually only fixed for a couple of years, and then they float with the market. That means your monthly payment could jump up. And believe me, the differences don't stop there. Let's look at how long you can actually take to pay the loan back and what happens if you suddenly come into some money and want to pay it off early. Now, this stuff might seem like boring fine print, but trust me, it's all about your financial freedom down the road. Okay, this is so important. An HDB loan gives you an exit ramp. You can pay it off early with zero penalty, and you can decide to switch to a bank loan anytime if you find a better rate. But it's a one-way street. Once you take a bank loan for your HDB flat, you can never, ever switch back to an HDB loan. That's a massive decision, one you absolutely cannot undo. All right, so you've picked your loan. Phew. But guess what? The choices aren't over. The next big one is about your monthly payments. Are you going to use your CPF savings, the money that automatically goes in there every month? Or are you going to pay for it with cold, hard cash from your salary? Now, this seems pretty straightforward, right? Using your CPF is super convenient. It frees up your cash every month. Using cash feels a little tighter on the budget, but it lets that retirement nest egg in your CPF just keep growing at a guaranteed 2.5% interest. But, and this is a big but, there's a hidden cost to using your CPF, a hidden cost that catches so many people by surprise, often when it's way too late. Okay, this next part is probably the most important thing we're going to talk about today. We need to talk about a critical concept called CPF accrued interest. Because understanding this, or not understanding it, is exactly how a sweet profit on your home can vanish into thin air. The best way to think about it is this. When you use your CPF money to pay for your house, you are, in effect, borrowing from your future retirement self. The accrued interest is what your future self is charging you for that loan. So when you sell, you have to pay back everything you took out, plus all the 2.5% annual interest it should have earned. And this is where things can get shocking. And no, this is not some made-up story. This is a real-life example of a seller who paid for his entire flat using his CPF. After about 10 years, he sold it for what looked like a tidy $100,000 profit. But once you added up the principal he'd used from his CPF plus all that compounding accrued interest, it completely wiped out his paper profit. He didn't just see zero cash, he actually had to top up his CPF with his own money. And look, this order of payment, it's locked in by law. It's totally non-negotiable. First, you pay off whatever loan you still have. Second, your CPF account gets fully refunded. That's the principal and all that accrued interest. And only then, only after all that, do you get to keep whatever cash is left over, which is exactly why that final cash in hand number can be a real shocker. Okay, so after all that, you might be thinking, what on earth do I do? But it's not about panicking or picking one extreme over the other. The key is to find a smart, protective balance that works for you. So what's the play here?
What's the smart move? Well, the CPF board itself has a pretty clear recommendation. Try to keep at least this much, $20,000 in your ordinary account. You know, this one simple strategy is incredibly powerful. It creates this amazing financial cushion. It's a safety net that could cover your mortgage for over a year if you ever lost your job or faced some other emergency. That's peace of mind right there. And all the while, that money just keeps earning that risk-free 2.5% interest, quietly growing your retirement fund in the background. So you see, the big takeaway here is that this whole thing, HDB versus bank loan, CPF versus cash, it isn't just about chasing the lowest interest rate you can find today. It's a much, much bigger decision. It's about your personal cash flow, your comfort with risk, and maybe most importantly, your long-term goals for retirement. Really thinking about that question, that's your first step. Are you trying to minimize your expenses right now, today? Or are you focused on maximizing your future nest egg? Because answering that for yourself, that is the key to making what is probably going to be the smartest financial decision of your life.